Most of the people run away when they hear the word balance sheet. But if you want to get serious about investing, then there's no escaping it. Today, let's break it down in the simplest way possible. No complicated jargon, only the essential. And hopefully, by the end of this video, you'll actually enjoy looking at a balance sheet. What is a balance sheet and why does it matter? Think of a balance sheet as a photograph, not a movie. Just a snapshot of the company's financial position on a particular date. So if you are looking at a balance sheet of the 31st March 2025, then that is what the company's finances looked like on that particular date. This financial statement shows two big things: what the company owns and what the company owes. And why does this matter? Because it shows how stable a company is, whether it is financially strong or fragile. Unlike the income statement, which shows the company's performance, or the cash flow statement that shows the actual movement of cash, this is just a status, like I said, a snapshot of the company's financial position. And although it's just a snapshot, this can reveal a lot. The formula: assets minus liability is equal to owner's equity. The balance sheet always balances. Assets is what the company owns, liability is what the company owes. Equity is basically what belongs to the shareholders after the company pays off all its debts. Formula is very simple, but it becomes the foundation of understanding business finance. Assets, what the company owns. Assets can be split into two parts: current assets and non-current assets. Current assets are short-term, cash, inventory, money to be received soon, and non-current assets are long-term, fixed assets, factories, machinery, and patents. A healthy company usually balances both: enough current assets for day-to-day needs and strong long-term assets for growth. But beware, not all assets are equal. Sometimes the company shows inflated asset values that may not be very useful. Number 4, liabilities, what the company owns. Liabilities can also be divided into two parts: current liabilities and non-current liabilities. Current liabilities are those liabilities that are due within the year, like bills to suppliers, short-term loans, and non-current liabilities are more long-term, like bonds, borrowings, or lease obligations. Now, mind you, too much debt can be risky, but a healthy amount of debt can actually push the company to the next level. In fact, debt could actually be a better idea than raising equity, because when you raise equity, you're diluting equity of the existing shareholders. So sometimes going for a loan will be a better idea than issuing new shares. This way, the earnings per share of existing shareholders is protected. But remember, it is a double-edged sword. Too much borrowings can collapse the whole thing. Number 5, equity and reserves, shareholders' equity. Like I said earlier, equity is what belongs to the shareholder. This includes equity capital plus retained earnings plus reserves. For example, if the company earns profits and reinvests everything for growth instead of paying them out as dividends, this money gets added to the reserves. And this can be a strong indication if the company is building strength for the future or just distributing cash to its shareholders. Now for the slightly advanced bits, when the balance sheets get tricky: consolidated versus standalone balance sheets. Now, why are there two types of balance sheets in one annual report? Because standalone company's balance sheet is just the parent company, while the consolidated balance sheet is the parent company plus all its subsidiaries. So always prefer the consolidated balance sheet for the full picture. Next, in the slightly advanced concepts, deferred taxes that pushes taxes in the future. Now, what are deferred taxes? Deferred taxes are accounting quirks that shift taxes to the future years. Next up, contingent liabilities. These are the possible risks, like a lawsuit that may or may not hit the company. And sometimes details about these contingent liabilities are buried in the footnotes. That is why going through the footnotes is ever important while analyzing a balance sheet. Another complicated concept in the balance sheet is lease liabilities. Now, even long-term leases can be recorded as lease liabilities. That changes the debt picture. And yes, we will cover all these topics in greater detail in the coming videos. Number 7. Why does a balance sheet matter to investors? So why should you as an investor care about the balance sheet? Because a strong balance sheet can give the company flexibility. A strong balance sheet can nurture growth, handle downturns or a difficult period, and give cash back to shareholders. And what does a weak balance sheet look like? Too much debt, very little cash, and now this makes the company vulnerable even if the sale is growing. It does not have enough cash to handle difficult phases of the economy or changes in competition. Basically, a bad year can finish off such a company. And that is why ace investors like Warren Buffett always start with the balance sheet, because it is the foundation.